Have you ever heard of the term exchange rate? The exchange rate is a nearby yet distant object. As a result, many market participants dismiss it as unimportant. However, the existence of an exchange rate is one of the indications that has a considerable impact on stock investment. 1. Consider it from a macroeconomic standpoint. Currency changes have an impact on import and export prices. Even though crude oil is imported at the same price, the price in dollar terms rises if the exchange rate rises. For example, if the dollar-euro exchange rate climbs from $1 to $1.200, the amount of dollars required to purchase a barrel of Brent at $100 jumps from $100 to $120. When the price of imported raw materials and parts is converted into dollars, the production cost rises, causing producer prices to rise and, eventually, consumer prices to climb. Exchange rate variations have an impact on both exports and imports. If a $600 smartphone is sold to Europe and the dollar-euro exchange rate climbs from $1 to $1.200, the selling price of the smartphone in Europe falls from $600 to $550. As a result, as the exchange rate rises, the price competitiveness of Korean firms' products in the international market grows, as do exports. Imports, on the other hand, fall as the dollar-denominated prices of imported items rise when the exchange rate rises. As a result, an increase in the exchange rate improves the current account balance by increasing exports and decreasing imports. Finally, swings in exchange rates affect the profit and loss of particular economic agents. When the dollar-euro exchange rate rises, for example, the profitability of exporting companies improves, therefore workers in connected companies may benefit from the growing exchange rate. When the exchange rate rises, economic agents who travel abroad or send remittances to their family abroad may require more dollars than previously, which might increase the expense. From a macroeconomic standpoint, when the exchange rate rises, exports grow, and when exports rise, corporate earnings rise, causing stock prices to climb. When the exchange rate falls, so do exports, and when exports decline, so do corporate profits and stock prices. 2. Consider it from the standpoint of the stock market. Consider a market in which the dollar-euro exchange rate is increasing. Assuming that stock market prices remain constant, foreigners will lose money due to the exchange rate. As a result, international investors typically sell stocks. In brief, an increase in the exchange rate leads to a fall in the value of domestic assets invested in by foreigners, which leads to the sale of foreign equities, which leads to a decrease in stock prices overall. Fall in the value of domestic assets invested in by foreigners, greater than purchase of stocks by foreigners, greater than rise in stock prices in this direction. Interest rates are ultimately tied to exchange rates. Recently, the United States has been steadily boosting interest rates. When interest rates are raised, you earn more income even if you simply deposit the funds in your bank account. If that is the case, a large number of investors will wish to collect the money invested all over the world, convert it to dollars, and deposit it. Naturally, demand for the dollar surges, causing the dollar's value to soar even further. So, what is the current value of the dollar? Let's talk about it. First and foremost, what is the underlying cause of the dollar's rise? 1. The value of the dollar has plummeted dramatically. To begin with, the government dispersed a large amount of money due to the epidemic, fearing a recession. As a result, the value of the dollar plummeted dramatically. 2. The conflict between Ukraine and Russia. The battle disrupted global supplies, causing the prices of raw resources such as grain and natural gas to rise. 3. As a result of the war's massive liquidity flow and inflation, interest rates were hiked proportionately. Raising interest rates reduces borrowing, investment, and consumption while increasing deposits. Consumption falls as a result. As a result, interest rates are swiftly hiked in order to control inflation. 4. The Chinese economy is suffering. As China's COVID-19 increases, major cities such as Shanghai have been placed under lockdown. As a result, factories are still closing. It was economically devastated. China decreased the benchmark interest rate in order to stimulate the economy by releasing money into the market. As a result, the yuan's value fell, while the dollar's value increased. So, what happens in the future? Prices have steadied to some extent, according to the recently published inflation rate. As a result, it is acknowledged that the interest rate climb is coming to an end. The Ukrainian-Russian conflict is also coming to an end. Furthermore, China's COVID blockade is gradually being loosened. Furthermore, since the dollar's worth has achieved its highest level in 10 years, there is only 1 point remaining for the dollar's value to fall from all angles. Where should we put our money if the value of the dollar falls? Which currency has dropped the most at this point? That is the yen in Japanese. The yen is regarded as a secure asset. Why is it regarded as a secure asset? What are the prerequisites for being a secure asset? 1. A market risk that is unaffected by market conditions. 2. Liquidity risk, with minimal room for settlement issues due to currency liquidity issues. 3. All credit risks that necessitate the currency issuing country's high credit rating must be met. Currency that excels in these 3 areas is described as a safe asset. Japan is a world-class manufacturing country with strong domestic and exports. Foreign exchange reserves are also the second greatest in the world by current standards. In other words, there is a very minimal probability of encountering a liquidity crisis while switching funds invested in yen into dollars, in which investors are unable to exchange their yen into dollars due to a lack of dollars. The yen has acquired its safe haven status for these reasons, which satisfy all of the criteria for safe haven assets, but there are 3 more grounds to classify the yen as a safe haven asset. Furthermore, Japanese citizens are heavily investing abroad. When the economy of the overseas financial market or asset market is bad, a large portion of this money returns to Korea. Because the dollar is changed into yen throughout the import process, the yen's price does not fall even during economic downturns. 4. Inflation money's worth is intimately tied to inflation. The higher the value of a country's currency, the lower or no inflation it has. In other words, currency is more valuable in a country where deflation is frequent, such as Japan. The Japanese yen is prized as a safe haven asset for the second reason. The Japanese yen, which does not raise or even fall after 10 years, is far more valuable than the yen of a country that has annual inflation of more than 10%. As a result, if you have yen that does not rise in value due to inflation, you have a safe asset because the yen reflects the asset value even in an inflationary climate. If rising commodity prices and labor expenses are a natural phenomenon, the exceptional situation in Japan can be blamed. 5. Japan has 0 interest rates. Japan is a country that consistently has a trade surplus. So I invested a lot of money abroad, and Japan's 0 interest rate also helped. If interest rates in other nations, such as the United States, are 3%, Japan enjoys 0 interest rates, implying that profits are always earned by investing abroad. Mrs. Watanabe even emerged, lending yen in Japan and investing in dollars abroad. As a result, excitement for abroad investment is great, and overseas investment has naturally increased. As this process progressed, international net assets increased. Normally, funds from the sale of foreign net assets should come into Japan, causing inflation. In Japan, however, it is feasible to borrow yen at 0 interest rates. Continued to make foreign investments as a result, domestic money continues to flow out of the country, preventing inflation. As a result, the impression that the yen is a long-term deflationary currency and so a safe haven asset has been planted. Why should you invest in yen? In the following video, we'll go through it in great detail. I'll be back with a better video next time. Thank you for tuning in today to hear J&J Stock Storytelling.